You would have made so much more money if you just understood risk management. This is the only risk management guide you will ever need. I'm going to cover why you need risk management. I'm going to talk about stop loss theory and practical implementation. I'm going to show you how to size your trades, and we're going to talk about risk per trade. And then at the end, I'll also show you how to get access to even more advanced concepts for free, of course, after this video. If you ever plan on trading or investing, watch every second of this video. If you don't, you are guaranteed to lose every penny you ever make. I have had friends go from $20,000 to a net worth of over $200 million to debt, all in the space of 2 years, because they couldn't manage risk. I've had another friend lose his entire net worth of $20 million because of the anchor crash. And some of these people I mentioned, you probably follow on Twitter and YouTube. These people are world-class traders and businessmen, but they just didn't understand how to manage risk. No matter how rich you get, you still need this or you're going to lose everything. I mean, take 3 Arrows Capital, for example, a multi-billion-dollar fund with all of the infrastructure, capital, network, connections, pretty much everything you need to be successful, but they weren't managing their risk, so everything evaporated and they went to zero. Take out a notepad and watch this entire video. If it's too long, swap to 1.5x speed, but make sure you watch it. And if you do watch it more than once as well, you can't afford not to. I split successful trading and investing up into 3 different categories. Number 1, you need your edge, your advantage in the market. Previously, we've taught technical analysis and fundamental analysis. Both of these are examples of edges. Then today we're going to cover risk management, and then very soon I'm going to release a psychology course as well. Now, my number 1 guiding principle for risk is simply this. The more risk you take, the more money you stand to both make and lose. The less you risk, the less money you stand to both make and lose. When people risk a lot, they tend to forget about the fact that they can lose a lot. When people don't risk a lot, they actually tend to forget about the fact that they can't actually make a lot. Now, one of my favorite charts to look at is this one over here. And what this chart does is it shows how much money you need to get to break even when you make a certain loss. For example, if you lose 10% of your portfolio, you only need 11% to make back your money. However, if you lose 60% of your portfolio, you'll then need 150% to get back to where you originally were. And it gets even more ugly as you get lower down the chart. Now, the first tool we're going to cover are stop losses, but there's an even more risk management tool that not that many people know about that you need to use before that, and that is subscribing to this channel. What is a stop loss? A stop loss is a point at which you decide to exit your trade at a loss. Here we have the BTC chart, and let's say when it was at 60K, you decided you're looking to long the breakout of 60K, and we got a nice big candle close, and you think, it's time to open a long. So you open a long at, say, 62K because you catch the breakout, and you target, well, you're planning on selling, let's say, at 80K for a nice 30% profit. Now, what happens is the price comes down. And if you didn't have a stop loss and you just left that position open, well, you'd be down quite a lot right now. You'd be down about 70% on your original position, which is a huge loss. But technically, you wouldn't have actually taken a loss because your position would still be open. So a stop loss helps protect our capital, but the cost is win rate. It also puts profit into context. So let's say our stop loss is placed 10% below entry over here. That means we either gain 30% or we lose 10%. It means we are risking 10% in order to gain 30%. Now, a stop loss alone is not enough for the entirety of risk management, and we'll cover the other factors later in the video. So the first factor I want you to consider when placing a stop loss is if you place a stop loss really close to your entry, you're going to lower your win rate, but you're going to lose less. If you place it further away, you're going to increase your win rate, but you'll lose bigger when you lose. Next, your market order type. I'll show you exactly how you place these on a trading exchange in a moment. But remember, I always personally use market orders for my stop losses. This means that they will execute immediately when the target price is hit based on what the market has. You need to be careful if you're trading low liquidity coins. This could result in a lot of slippage. Now I'm going to teach you every single type of stop loss and show you exactly how to place it. So let's go over the first type of stop loss. And the platform I'm going to be using here is FTX. If you guys want to sign up and use the same platform, there's a link in the description below with a 10% discount. That's the biggest discount you can possibly get on this platform. So we're going to be looking to enter a position at 19,260. And if we take a look, I'm going to set my profit target at, let's say, 19,300. So if the price goes up, I make 0.21%. Now, the first type of stop loss is a flat percentage stop loss. Now I'm going to put 0.1% as my flat percentage stop. When I enter positions in a scalping scenario like this, I decide that my stop loss will always be 0.1% under my entry. Now, if I'm trading on a higher time frame, that might be 1%, that might be 10%. It really depends on what you're trading and what your strategy is. The consistent thing though is that you're always setting a flat percentage. Now, the good part of this is it's very easy to place, it's very easy to backtest, and it's a nice simple place to start. The downside is that it does not account for the market conditions and the relevant price data on the asset you're trading. If you ever get into automated trading, this is very nice because it's, again, very easy to set and very easy to backtest over a long period of time. So I'm going to actually buy some BTC so I can show you guys how to place these orders. So we'll set the price to 19,300. So we have just bought our BTC at 19,300. So now to go set a stop loss. So yeah, I just set this up. I'd set the stop market order at 19,282. So we'd put 19,282 over here. The order type will be stock market and we'd click sell. Now you can see here, our sell stop is right over here. If the price ever comes down to here, we will be able to exit our position. And we have our sell order up here at 19,339. Our position is complete and set up, ready to play out. Now let me show an alternate type of stop loss that I really like to use. These are called trailing stop losses. If you go to order type and you click trailing stop loss, let's cancel our previous one. So we've canceled our previous orders and now we're going to set a trailing stop loss. So this will trail. That means follow the price for whatever value you set. So if I click minus $100 over here and I set up the position, I click sell, this will now follow the price behind it by about $100. So if you scroll down here, you can see the trigger price and the market price. Currently the market price is 19,314. The highest it went to was 19,315. So the trigger price right now is 19,215. When the price hits 19,215, it will trigger our trading stop loss. And as the price goes higher, this trigger price will continue to go up. Now, I really like trading stop losses. There are a lot of good pros. For example, they're really good at capturing enormous gains. If you capture a breakout and the price absolutely flies up and it enters a monster trend, keeps going up and up and up, you can catch a huge percentage of that move. You can also just set and forget, because once you set it up, you can walk away and you know it'll keep following the price and keep capturing a good percentage of that move. Now, the downsides are that trading stop losses absolutely suck in choppy conditions. So if the price is going up and down a lot, if you see any sort of big candles to the downside, you could potentially lose on enormous gains. So now we're going to cover my favorite type of stop loss. My absolute favorite type of stop loss is an invalidation stop loss. So let's say I entered here at 19,300 because my thesis was that the price is going to go up. And then we set here our target. So let's say I'm targeting up to this previous top over here, about 0.64% gains. Now, where I'd set my stop loss would be based on technical analysis. So what I'd do is I'd zoom out, I'd look at the market structure, and I'd spot a good support level over here. So this 261 level looks like a good support. So if this support breaks, I probably want to exit this position. So I'd give it a little bit of space over here. We got below this low here and right where these big wicks were over here. So if now the price goes below this support that I think has quite a few data points, I see my bullish thesis, the thesis that the price is going to go up, as invalidated. So based on technical analysis at this price level, my thesis is invalidated, therefore I will exit the position. Now, huge advantages to this strategy. Firstly, it factors in current market data. It's going to look what the current situation is. If it's very volatile, it'll take that into account. If we're in a bit of a unique situation with regards to distance from support, a unique market structure, it takes all those factors into account. Also, it takes advantage of experience. The better you get at pattern recognition, the more skilled a trader you become, the more powerful this strategy becomes. However, there are some very strong cons here. For example, firstly, it's very difficult to test this because it's always tweaking slightly based on your logic and hypothesis. And while we can have tools to make us more consistent, for example, building checklists, having an up-to-date trading journal, it's still very difficult. This also requires a lot of experience. For newer traders, invalidation stops based on technical analysis are not going to be very reliable, though you do need to build that skill set up. Finally, the biggest downside here is they're very prone to emotional mistakes. Once you set a trailing stop loss, it's over. If you have a flat percentage stop, you always will cut your losses at 1%, 0.5%, whatever you've set that to. However, with invalidation stops, you can always try reason your way out of your initial position and change your invalidation thesis, and often emotions can make you do silly things there. Now, there are two more advanced types of stop losses, relative volatility stops and timed stops. Now, I'll cover all of these in my advanced guide. Now, what do you do after you set your trailing stop loss? Well, take a look at this example right here. I'll show you a real trade. So over here, look, we have resistance right between the 236 and 382 level. If you don't understand any of this technical analysis, there's plenty of other course lessons explaining all of it on my channel. Now, let's say I want to enter a trade right over here at the 236 as the price comes down. My invalidation is if we get down to the 0.5 level. You know why that is a bad thing for Fibonacci's. And now let's set it over here. My target is just under 22K. That gives me a risk to reward ratio of 2.35. So I'm going to show you a 3-step process. First thing you do, identify risk to reward ratio. We have it at 2.35. Is that good? Is that bad? It depends on this. And that's step 2, understanding your minimum risk to reward ratio based on your historic win rate. Now, I'll pop the formula up on the screen for anyone who wants to look into that. But for everyone else who doesn't want to do the calculations, here is a cheat sheet. If you have a win rate of 25%, you need a minimum of 3-to-1 risk to reward ratio. That means you need to at least make 3 times more money than you stand to lose. If you have a 50% win rate, you need to at least win as much as you lose to break even. Now, this gives you the break even amount. In an ideal world, you actually want to be quite a bit above this. The best traders deviate quite a bit. If they've got a 3-to-1 risk to reward ratio, they'll have a better win rate than 25%, somewhere closer to say 30%. If they're taking 1-to-1 risk to reward ratio trades, they're going to have a better win rate than 50%, as high as say 70%. You really want to get yourself into a comfort zone, especially when you take into account the fact that the exchange is going to have fees, there's going to be slippage involved, and it's not always going to play out perfectly, especially as you get to larger position sizes. Now, step 3, if you really want to take this seriously, you need to understand your risk of ruin. You need to understand the variance in your strategy based on your win rate and risk to reward ratio. This will be covered in the advanced guide. Now we're going to cover position sizing and risk per trade. To know your position size, you need 3 pieces of information. You need to know your account size, you need to know how much you can risk per trade, and you need to know the distance of your stop loss from your trade. You put all this information into this formula and that will give you your answer. So let's take this example over here. Let's assume our portfolio size is $1,000. We can see the distance of the stop loss from the trade here is 3% and we're willing to risk 2% of our portfolio per trade. This means our position size can be $666.7 big. The formula itself is actually pretty easy. The bit that can be very tricky is knowing how much of your portfolio to risk per trade. Now, there's a simple answer and then there's a more complicated answer. The simple answer is 2%. Just risk about 2 to 3% of your portfolio per trade. It's a very safe place to be. You're not risking so much that you've got a very high risk of ruin. That's when you go to 0. And you're not risking too little as to which you'll never be able to make any meaningful gains on your portfolio. Now, there are a few other strategies. For example, you can do a flat fixed size of loss per trade, irrespective of your portfolio size. If you have certain goals, you can also do discretionary sizing of risk, especially if you have a lot more experience, but we'll cover these in the advanced guide. For now, most people watching this video can stick to 2 to 3%. Nothing extra, just the essentials. This video has everything you need to have sufficient risk management. Yes, you can do more, but this is where you start. These are the basics you master before you move on to anything else. For people ready to take the next step, I've got something special for you. You can join my Telegram. This is free. And on the Telegram, I'm going to give you guys access to the waitlist for the advanced guide. I'm going to give you PDF summaries of this entire lesson. I'll give you a homework assignment where you'll be able to make your own risk management plan based on these basics, and there'll be a ton more free content for you. That's everything from me. Thank you for tuning in.